What's up you guys, I'm Dan, this is Frugal Not Cheap, and today we'll talk about how I am going 50% international stocks. So a few videos back, I talked about how I was getting rid of a relatively small bond allocation that I had built up late last year. I'd put that bond position on in order to take advantage of sort of better risk-adjusted returns from diversification. And as I was getting further along my path towards FIRE, I figured it would make sense to start becoming a little bit, having a slightly more conservative asset allocation. I will say, I think you can hear there's a little bit of market timing, which, again, I never think is a good idea. I'm prone to making mistakes just as any other human. And in general, what's been going on is I'll reassess my strategy, my long-term strategy, but at the same time, I might make the decision to implement findings from my reassessment at a time that seems opportune, which of course is a bit of market timing. Definitely want to put that out there. Although, as I mentioned in that video, things did work out quite well. But that's not really why I switched away from the bonds. It's more that I found that during this huge decline, that having that bond allocation wasn't really any sort of salve on the wound psychologically for me. Because I'm still working, so I have income coming in, so I just don't feel right now that having those bonds to sell or to draw from is really not all that important to me at the moment. So I just went ahead and reallocated this, again, relatively small allocation of bonds out of the way, and went back to 100% equities. And at that time, I also let you know that I would be moving to 50% US and 50% international equities when I was able to rebalance, and that's today on August the 19th. So why am I doing that? Well, actually, I'm really just rebalancing. So this is not new at all. My long-term asset allocation has always been 100% equities with a very large share relative to a lot of US investors in international equity, as I like to follow more sort of the global market capitalization. Although, as we'll see in today's video, I do still have somewhat of a bias. But first, let's talk a little bit about diversification. So one of the really, I think, useful tools to visualize the importance of diversification is something called the Callan periodic table of returns. So here, it basically ranks different asset classes by performance in a given year. And I think what you can see here is that one asset class does not maintain the top spot throughout time. We're looking here at the period 2002 to 2021, and you can see that large cap stocks, which began the period as the worst performing asset class, ended it as the best performing asset class. Conversely, global ex-US fixed assets, in other words international bonds, went from being the best performing asset class to being the worst performing asset class. However, and this is probably something that most people don't dig into right away when they look at this periodic table, is that the ranking, the ordinal ranking, is one thing, but the other thing is also what the returns are actually like. So let's take that top row of the top performer in any given year. Very unusual that first year international bonds had a huge year, performing around a 22% gain. That's the only year that they were the top performer in the entire series. And in fact, there were only 3 years where fixed income was the best performer. In the other 2, it was US fixed income, and we were seeing single-digit returns for those years. Generally, the pattern that emerges, though, is that the big winners are going to be, of course, stock funds. We do expect that there's going to be some equity risk premium. In other words, that stocks, being riskier, should be paying some kind of a premium. Otherwise, investors would just put their money into bonds. And so we do actually see that this risk premium does materialize. 26%, 31%, and so on for the different equity funds in their time as the top performer for the year. Now, in terms of my decision to go 50-50 US international, in terms of performance and ordinal ranking, really you'd want to look at sort of the orange color, that's the emerging markets, and then also this kind of light brownish gray color, that's the developed ex-US stock markets. And you can see that very often they're in the top 3, and also that percentage returns within a year are relatively quite high. So certainly we can see here that there's some benefit to diversification. Certainly the emerging market stocks might be riskier than developed market stocks in the US and abroad. There does seem to be some kind of a risk premium that's paid for that, and so that could be useful. But again, I try to be a little bit more market agnostic and sort of trying to buy the overall global stock market. So taking a look at that, SIFMA lets us know that the US markets continue to be absolutely the largest and most developed stock markets in the world. And in 2021, of the $108 trillion global market cap, the US represented 40% of that, ranging from around 33% back in 2012 to as high as 42% in 2021, as US stocks heavily outperformed ex-US stocks that year. But here already you can see that actually I am already overweight in terms of US stocks compared to the global market share. And there are some reasons for that. We have very, very deep financial markets with very strong institutions. Now, yes, we have some, sort of lobbying and regulatory capture and some fraud issues in this country, but they're much, much better than in a lot of other places. So having these deep markets, the rule of law, property rights protected very strongly, having regulatory bodies such as SEC, having things like SIPC and also FDIC insurance, all of that does lend itself to thinking it's probably a good idea to, at least in my view, be a little bit overweight the US against the rest of the world, but then also noting that, developed markets in Europe and in parts of Asia, Australia, other places, we have all of these kinds of institutions well in place as well. The markets are not as deep and everything like that, but they're still relatively good places, I think, to invest in companies. And so that's why I'm going 50-50 US international. It's also going to be a little bit easier just to, rebalance periodically, probably annually, and go back to that 50-50 mark over time. And then who knows, this might change in the future. In history, no power has ever remained the #1 power forever, right? We had the Roman Empire, then the fall of the Western Roman Empire, power shifting towards the East. We had Egypt. We have all these different powers. Even more recently, the United Kingdom. This empire that spanned the entire globe. Right, the sun never set on it. And then they've heavily waned and in fact become quite insular now. And so, financially, yes, London's still very important, but in terms of empire and being a world power, England, not so much anymore. So that one's going to be tricky, and certainly it's not something that people like to think about for their own country. It's uncomfortable, but me having sort of grown up abroad and really feeling more kind of like a world citizen than tied to any one country, I think it's a little bit easier for me to look at those psychologically difficult things, maybe. I don't know. While we're looking at charts of investment returns and all this stuff, I thought it might be useful to kind of show you where my thinking came from on this stock bond allocation deal. So I went to Portfolio Visualizer, a great free tool, by the way. And I set up a couple of different portfolios. I set up a 50-50 US international stock portfolio. I set up a 50-50 US international bond portfolio. So 100% equities against 100% stocks. Each of those split up 50-50. And then I took another one where I went 60% stocks and 40% bonds in order to show you what the impact is of having a decent sized bond allocation. The old 100 minus your age formula would have you put this on at around age 40, because 100 minus 40 would leave you at 60, and that's your stock allocation. Right, was what the rule had you do. And of course the rule works because as you get older, then it pushes you to increase your bond allocation. There have been, tweaks on sort of what the best rule of thumb is now, but anyway, I think it's a useful idea anyway. All right, so the red line here is just 100% bonds, and you can see that definitely the impact that they have marginally is to smooth the ride, right? So whereas the 100% stocks, which is in blue, the 60-40 stock bond allocation, which is in sort of the orange, these are much more volatile, have much more swings than, of course, the bond fund, the bond portfolio. And in fact, in this period we're looking at from 2001 to 2022, we're seeing a bit of an unusual thing, which is for a lot of the period of time, 100% bonds, again, this is 50-50 US and international bonds, actually outperformed the primarily equity portfolios that we're looking at here. This is because stocks started off the period performing quite poorly from 2001 to 2003. Then, of course, we had the Great Recession in 08 and 09. Also saw them take a big hit. And then they took another dip when we had the COVID-19 pandemic. So these bonds really cut down the standard deviation. They also make your worst year a lot less worse. With 100% stocks, you're seeing a worst year loss of over 40%, whereas with the bond portfolio, we're seeing a loss of just over 10%. However, on the other side, whereas you're seeing a best gaining year of only about 14% for the bond portfolio, the 100% equity portfolio sees a gain of nearly 36%. Not only that, but even though the bonds outperformed for a long period of time here, we can see that in the long run, they really just represent a drag on the portfolio, as both of the stock-heavy portfolios have significantly outperformed it when we look at the entire time frame. And that same argument, to a lesser degree of course, applies to the 60-40 stock bond portfolio, where yes, it did smooth out the ride oftentimes when fixed income was outperforming. This portfolio also outperforms the 100% equity portfolio. But in terms of total returns, when we look at the entire period, they are lower, and so there was a drag. So if that benefit of having that safety, having that psychological salve really isn't there, which it isn't for me, then especially in the accumulation phase now, it makes more sense for me to be 100% equity because I can weather the storm. Now, the difference in the compound average growth rates of the 100% stock portfolio, which is 6.11%, and the 60-40 stock bond portfolio, which is 5.77%, may not seem that big, but these small differences, as we've talked about with with mutual fund fees, for instance, expense ratios, these relatively small differences compound over time until they'll make a really big difference in terms of the actual portfolio balance. So to that end, let's zoom out a little bit also, because we could be cherry picking or just by chance end up looking at a particular period of time, which gives you a certain result and might be really clouding your view on things. So it's better to look at multiple time frames, longer time frames, to get a real sense of everything. If we zoom out to where we're going back all the way to 1992, then a different pattern emerges, and we can see here really the more long run pattern, which is that fixed income, of course, significantly underperforms against equities. And this should be the case, right? We would not put our money in stocks, which are more risky and volatile than in bonds, if we weren't going to receive some kind of a risk premium. And by the end of the series, looking at the full thing, then we can really see, I think, the impact of the fixed income being a drag on the portfolio. So the compound average growth rate of the 100% bond portfolio is just 5%, well below the 6.8% given by the 60-40 bond portfolio. But then when we look at my chosen asset allocation, we have nearly a 7.5% compound average growth rate. 1% per year compounded over many years is going to make a really, really big difference, so long as I can stomach the downturns and never panic sell. So that's where I'm at. That's where my portfolio will be during the rest of the asset accumulation stage. 50% US, 50% international, 100% stocks. Your situation might be completely different. You might have very different considerations or be at a different point in the journey from starting investing to the accumulation phase to retirement, right? The drawdown period. You might have a very different risk tolerance. You might have a very different view about the United States versus the rest of the world. But in any case, I hope the benefits of diversification that we saw in the Callan periodic table is useful. Also, though, to look at those also from the lens of actual return values and not just their ordinal ranking amongst asset classes, and then making sure to look at longer periods in history and not just happening to look at a certain short period of time that makes you think one thing that might not be valid when we look at a wider period of time. I think really all of that analysis could be useful regardless of where we are and what our different preferences and tolerances might be. If you did like the video, please hit the like button and consider subscribing. Thank you very much for watching, and I'll see you in the next video.